For the first time in 60, that's 60, years, the most famous letter in the entire investing world has a new author. Now, Warren Buffett is obviously a tough act to follow, but his successor's very first message, well, it's sending some serious shockwaves through the market. So let's break down exactly what it means.
This isn't just a simple leadership change. This is a monumental shift for investors literally everywhere. For decades, Buffett's letters were treated like financial scripture. So today, we're going to decode what his successor, Greg Abel, is signaling with his first turn at the pen.
All right, here's our game plan. First, we'll look at Abel's first big move, which seemed to scream business as usual. Then, we'll decode the surprising and pretty cautious signals in his letter. After that, we're going to compare his leadership style to Buffett's. And finally, we'll figure out what this big warning could mean for all of us.
Okay, let's jump into our first section. Abel's first public move seemed perfectly designed to reassure everyone that the old Berkshire playbook was still very much in place.
The big news was the restart of share buybacks, and this was a really big deal because it came after 6 straight quarters of nothing, radio silence. Suddenly, the company was back in the market, buying its own stock, a classic Buffett move that tells the world, hey, we think our shares are cheap right now.
So, naturally, this immediately brought up the #1 question on every shareholder's mind. Is the new guy making these huge capital allocation calls on his own now? Was this purely his decision?
And Abel's answer was super direct and honestly pretty reassuring. He confirmed he talked it over with Buffett, they analyzed the intrinsic value and the timing together, and that sent a crystal clear signal to the market. This is a stable, collaborative transition with a deep respect for the old guard.
But, and this is a big but, while that buyback suggested everything was the same, Abel's first letter to shareholders revealed a very different and much more cautious story hiding just beneath the surface.
Just look at this number for a second. $373.3 billion. Greg Abel didn't just inherit a company, he inherited an absolute mountain of cash. To put that into perspective, that's more than a third of the company's entire value, just sitting there, waiting.
So in the letter, Abel specifically calls this cash dry powder. And he says his role is to be intentional and deliberate with it. But here's the twist. He bluntly states the current market is short on compelling opportunities. Wow, that is a huge statement coming from someone sitting on that much capital.
Now, this cautious stance on the market, it was also matched by a dramatically different leadership style. This wasn't the folksy wisdom we're all used to from Buffett. This was something new, something a lot sharper.
You see, where Buffett almost never criticized his managers in public, Abel put them on notice. He publicly called out the performance gap at BNSF Railroad, one of the crown jewels of Berkshire, and then pointed to self-inflicted difficulties at another subsidiary. One analyst put it perfectly. In the world of Berkshire, those are fighting words.
So the crucial point here is this fundamental shift in management philosophy. And this illustrates the core change so well. We've moved from a model of decentralized trust, where Buffett hired great people and just got out of their way, to one of direct inspection and very public accountability. It's a whole new ballgame.
And this new, more combative style isn't just for his own team. Abel is taking an aggressive stance on the massive wildfire lawsuits against their utility, vowing to fight unjust claims instead of just writing a check to make it go away. He's also doubling down on Berkshire's old-school ways, confirming they will not hold quarterly earnings calls, basically telling modern Wall Street, we do things our way.
So what does all of this actually mean for the average investor like you and me? You've got the mountain of cash, the intense caution, the new leadership style. Well, it all connects directly to the state of the market right now.
Let's just look at the data. 2 of the most reliable indicators for spotting market bubbles are flashing bright red. The Buffett indicator, which compares the stock market's value to the country's GDP, is at 218%. That's more than double its historical average. The Shiller PRE ratio is also more than double its norm. These aren't just high numbers, these are serious warning signs.
And you know what? This isn't the first time Berkshire has taken this exact stance. We've seen this movie before. It's the same disciplined pattern Buffett followed back in 1999. He was called out of touch for holding cash and avoiding tech stocks, right before the dot-com crash proved him right. Abel is following that same script, not with words, but with his actions.
So the takeaway here is really simple. Greg Abel isn't confused. He's patient.
His inaction with that $373 billion is the loudest signal of all. It's shouting that he believes the market is overpriced and just plain lacks value right now.
The era of Buffett's folksy storytelling letters might be over. But Abel's first move suggests the core principles that built this company, patience, discipline, and buying real value, are definitely here to stay. And that leaves all of us with a really critical question. In a market that feels this expensive, is this new disciplined caution the playbook we all need to be studying?